I want to talk about the level of speculation in the market. We see stocks going up, up, and up, and up on the day that the capital was invaded. We also see Bitcoin going up and up and up. We see SPACs, we see IPOs. What does that signal to you?
Look, Ty, you and I have talked about this now for months with some degree of success in the summer and in the early fall, and then with less success with respect to the what we expect to be the downside risk in this market over the last couple of months. Look, I think there are enormous pockets of speculation. They may not necessarily apply to the entire market, but certainly when you look at something like Bitcoin and the parabolic move that it's had, and listen, I know I've been wrong about Bitcoin since it was first priced at 5 cents over a decade ago. It's gone up 842,000 times its initial price and made billionaires out of some people and made some of us look quite silly. I still think that's a speculative episode. I think that SPACs are also selectively going to face trouble. And I do think the 17 million individual traders who have taken to day trading and options trading are going to have a rough day somewhere down the road. So, yeah, look, I think there's a lot of speculation in this market. Again, timing it is the most difficult part of this. As you and I know, going back to 1998, when the stock market reached its momentum peak, it didn't reach its price peak till 2 years later.
Samantha, let me turn to you and get your reaction to what Ron just said, his concerns about speculation in the market. Another word for that, I guess, is froth. Good on a bottle of on a pint of Guinness, bad in the market. But I was really struck by your observation that maybe some of this year's gains were pulled into last year. Explain what the consequence of that could be.
That's exactly right. So it's always a balance. We love risk assets. It's how our clients transform income into wealth. That being said, there's a lot of exuberance, right? And you just have to look at some of the stats. So through last year, we made 20 all-time new highs in global equities. And this wasn't just the S&P 500, US small cap up over 30%, emerging markets up over 18%, and I could go on. And that didn't feel congruent with the environment. Yes, we know that we hit a bottom with the recession. Now, obviously, we're seeing pandemic-related weakness in the jobs data. It'll likely flow into the GDP data as well. But I just think it feels a little intellectually lazy to keep saying the market is a forward-looking mechanism. Yes, it is, but there's a lot more churn that has to happen. And we had a lot of those gains, a lot of those recovery, coming out of the pandemic gains, we got those last year. So we do think some of those returns, like you said, have been pulled back into last year's returns. And that just means we need to be a lot more cautious and a lot more selective in how we invest this year.
Shepard Smith here. Thanks for watching CNBC on YouTube.